This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 444. Today's episode is brought to us by SoFi, the folks who help you get your money right. Paying off student loans quickly and getting your finances back on track isn't easy, but that's where SoFi can help. They have exclusive, low rates designed to help medical residents refinance student loans. That could end up saving you thousands of dollars, helping you get out of student debt sooner. SoFi also offers the ability to lower your payments just $100 a month while you're still in residency. If you're already out of residency, SoFi's got you covered there too. For more information, go to SoFi.com/whitecoatinvestor. SoFi student loans are originated by SoFi Bank, NA member FDIC. Additional terms and conditions apply. NMLS 696891. All right, welcome back to the podcast. Thanks for what you do. Your work is important. Don't let anybody tell you it isn't. And if you just had a rough day, I'm sorry. Tomorrow will be better. Those of you interested in real estate, curious about real estate, not sure if it's the right move for you, have we got something for you? Join me on Thursday, November 20th, 6 p.m. Mountain, for a live session where I'll walk you through what physicians need to know before investing in real estate. We're going to cover the reasons real estate can fast track your path to wealth, the massive tax advantages most doctors don't take full advantage of, the different types of real estate investments, and how to choose the right fit for you, how to avoid common mistakes that derail returns, and some tools to evaluate real estate opportunities. So whether you're looking for passive income or diversification with the recent stock run up or a more hands-on approach to investing, this session will help you decide your next steps. Plus, I'll stick around and answer any of your real estate questions afterward. Okay, so register at whitecoatinvestor.com/REI. And 3 people who join live are going to win our No Hype Real Estate Investing course. That's the $2,199 value. Register again, whitecoatinvestor.com/REI. All right, let's do a correction. My favorite part of this podcast. You guys want to get in the weeds, and the harder the questions, well, the more likely I am to screw them up. This one, I don't know that I really screwed up, though. This one's kind of a pretty minor gripe. But a couple of podcasts ago, I talked about legacy holdings. One option to deal with could be to give to somebody in a lower tax bracket, right? A friend or a family member that's in the 0% tax bracket, right? So you give them this legacy holding, and instead of cash, they sell it because they're in the 0% long-term capital gains bracket. They have no tax consequences. Nobody pays taxes. You don't pay taxes. They don't pay taxes on the earnings, the increase in value of that particular investment. So it's great, right? But somebody writes in and says, "Oh, well, what about kiddie tax?" Well, this is true. Right? You got to keep kiddie tax rules in mind. If you're giving this to your kid that's under 18, the kiddie tax applies, right? And they realize a $30,000 capital gain. Well, yeah, you're going to be paying that at your capital gains tax rate. So this works for, your kids that are independent of you in their 20s, or you give it to them now and they just don't realize the gain until they're no longer, the kiddie tax no longer applies, et cetera. So keep that in mind. Obviously, the income from that will count toward their income, and above a certain amount, you got to start paying taxes on that at your tax bracket, but up to a certain amount, that would work. Just be aware of the kiddie tax if you use this particular technique with your legacy investments to give them to your minor children. All right, let's take a question off the speak pipe.
Hi, WCI team. This is Matt from Florida. I was wondering if you could speak to the pros and cons of reinvesting your dividends automatically versus having your dividends come to you, and what the thoughts are about doing that in a tax advantage account versus your taxable account. Thanks.
Okay. Great question. I love it. So I'll tell you what I do and why. And then I'll argue it's the best way, but obviously some people choose other things. What I do is in a tax protected account, right? An HSA, a 529, even my kids' UTMAs, even though those are technically taxable accounts, but certainly, 401ks, Roth IRAs, those sorts of things. I just reinvest the dividends. It's very simple. It benefits from the being automatic. And automatic is good because you don't have to think about it. It just happens. The day the dividend's paid, the dividend's reinvested. And so there's no lag there. There's no cash drag there. So I think it's a great thing, especially for those who might not get around to reinvesting that dividend manually for a while. But in our taxable account, I don't reinvest any dividends. They're all paid to the money market fund associated with the account. Now, they sit there in the money market fund and they earn some interest while they're there until we reinvest them. But I treat those in my taxable account the same way I treat all the other taxable income we made that month, right? Whether this is, a paycheck from WCI or some profits from WCI, or whether this is, a distribution from my physician partnership, or whether this is, some income paid from a real estate investment or dividends from, VTI or what. It all sits in that, money market fund until the first part of the next month when I invest our money. Right? We figure out, okay, well, this is about what we spent. So this is how much of what we made we can invest. And I invest it all at once, right? Everything we made from all sources, including dividends in that taxable account. And the benefit of doing that is well, there are multiple benefits. One, you have a lot fewer tax lots, right? I am not buying all 6 or 8 or whatever investments we have in our taxable account every month. Every quarter even, right? Every time a dividend's paid, I'm not rebuying that investment. So I don't have a gazillion tax lots to keep track of. And now it's a fair point that the brokerage will keep track of that. You don't actually have to keep track of it on a separate spreadsheet or anything. Vanguard or Fidelity or Schwab or whatever will keep track of all those tax lots. But it's a little overwhelming when you log in and you got 420 tax lots, right? And that's what you're going to have. You're reinvesting a dividend every month and buying, 0.37 shares or whatever of whatever it is you own. And so that's one benefit. It just kind of simplifies things that way. The other benefit, though, is when I invest manually each month, and sometimes it's like every couple months, whatever, I can direct that money at whatever's lagging. So this is one of the ways in which we kind of do our rebalancing. We're like, oh, well, stocks had a great 2023, 2024, and 2025 so far. So all this money that we're investing this month is going to bonds. Or this month, all the money we're investing is going to go into real estate or international stocks or whatever. And so it allows us to kind of manage the portfolio that way. And those are kind of the reasons why we don't do that automatically in the taxable account. The other thing to keep in mind is that, doing things automatically is great, but it doesn't mix well with certain things like tax loss harvesting. Right? If you are automatically reinvesting dividends, well, now you've bought shares of this thing within the last 30 days. So now you got a wash sale problem. That doesn't mean you can't do tax loss harvesting, but it's one more thing to be worried about, especially if you own the same investment in a tax protected account that you are tax loss harvesting in the taxable account. So keep that in mind. That can be another problem with automatic dividend reinvestment, is it can cause wash sales for your tax loss harvesting. So in general, do it in your tax protected accounts. Don't do it in your taxable account. But if you're okay not ever tax loss harvesting and you're okay having a gazillion tax lots, you can reinvest automatically even in the taxable account. It's not the end of the world if you do that. It's not wrong by any means. It's just not how I prefer to do it. Hope that's helpful. Hope that answers your question and helps you decide what you want to do with your own money. All right, our quote of the day today comes from Peter Lazaroff, who said, with investing, you get what you don't pay for. I love it. It sounds like a Bogleism, but it actually wasn't Bogle who said it. Okay, let's take another question off the speak pipe.
Hi, Dr. Dolly and the rest of the WCI team. Thank you so much for the quality content you produce. It's definitely helped my family's financial future, and I really appreciate it. Today, my question is on balancing the risk of retirement savings being held in employer-owned accounts versus the risk of significantly oversaving for retirement. Every year, about 55% of our tax-advantaged retirement savings would be held in accounts belonging to our employer, namely in a pension and a 457B. Obviously, both of those account types are not guaranteed and could technically be lost. Is that too risky? We could try to mitigate the risk by not using the 457B and going taxable, or by saving as though the pension doesn't exist. However, this seems like losing out on a big upside of both of those accounts. I'd love to hear your opinion on this, and I sent an email with the specific numbers for you. Thanks.
Okay, great question. I don't actually have the email in front of me. I don't think we needed to answer your question, though. I suspect I already responded to the email anyway. I'm pretty sure I've responded to every email that any listener has sent to me in the last 15 years. Let's talk about this, though, because this is a great question. It's not really out in the weeds, but a lot of people probably haven't spent much time thinking about this. It's true, something can happen to your pension. Pensions are great, especially if you want, a guarantee of some kind. The beautiful thing about a pension is the employer is taking the risk. You're not taking the risk with your investments. They're saying, I'm going to give you this benefit every month from now until when you die. And they take the investment risk. If investment performance is poor, they got to come up with the money, right? They got to put more into the pension. If investment performance is great, maybe they can put less in there and still meet their obligation to you. But they're taking the risk. That's the nice thing about it. So it provides you a guaranteed income. Now, the guarantee is only as good as the employer is. There is a pension guarantee corporation essentially out there, but it typically only protects a certain amount of a pension. So it is true that at least some of it is probably at risk to something happening to your employer. That said, would I not use it at all or get my money out of it just as soon as I can? I probably wouldn't. Just like a single premium immediate annuity, that guarantee has some value. And of course, the tax, protection and the asset protection has value. So I think a balanced approach is the correct answer. Now, where you make that balance is going to be kind of a little bit of an individual decision. Before we get to that, though, let's talk specifically about 457Bs. And the problem is there are two kinds of accounts, and they're both called 457Bs, but they're very different accounts. The first one is generally called a governmental 457B. And in that type of an account, usually offered by a government employer, your money is actually held in trust. Just like with a 401k or a 403B, they may say it's the employer's money because it's a 457 and it's deferred compensation that hasn't been paid to you yet, but it really isn't. It's your money. And you have the option when you separate from the employer of just rolling it into another 401k or into your traditional IRA. It's a pretty darn nice retirement account, and you ought to look at it as just another 403b or 401k and have no qualms whatsoever about using it. The other type of 457b, often called a non-governmental 457b or a tax-exempt 457b, is a different beast altogether. This is not held in trust. It still belongs to your employer. It is subject to your employer's creditors. Now, up until about a year ago, I would say I've never heard of a doc ever losing non-governmental 457B money. But right now, Steward Health, which used to own my hospital, and I'm not terribly fond of, is apparently saying at least some 457B money of some physicians is at risk. They went bankrupt, and maybe some of that is going to other creditors besides those docs who put money in the 457B. So I cannot say that it's impossible to lose money there. It's always been a theoretical risk, and it looks like it may be showing up. Obviously, that hasn't gone round trip yet, but it's a risk. Right? So you start going, well, I don't want all my retirement money in a 457B, a non-governmental 457B anyway. And the other thing to think about is on the back end, right? What money do you want to spend first? Well, the money that maybe you won't get, right? So the non-governmental 457B money is early retiree money, right? Spend that money first, right? Before you get into your taxable accounts, certainly before you get into your retirement accounts. Withdraw and spend that 457B money. Now, you generally have some limited distributions options, so you got to pick one that's reasonable. You may not want it all in one lump sum, especially if you have hundreds of thousands of dollars in there. But, taking it out over the first 5 years or something after you separate might not be a bad option. The other nice thing about it is there's no age 55 rule, like with a 401k. There's no age 59 and a half rule, like with an IRA, right? There's no penalty for taking money out of the 457B. Just pay the taxes in, if any, due on it, and you spend it. That's it. So it's a great early retiree account. But we've got to differentiate between governmental and non-governmental 457Bs while having this discussion of how much money you're leaving at risk. I do not think it should be ignored. some people do this with Social Security too. They're like, oh, I'm going to ignore Social Security. Well, what that means is that you're working in your 60s when you don't have to. You have enough money with Social Security, you don't have enough money without Social Security, so now you're working 4 or 5 more years that you didn't need to work. So I don't think that's the right approach. I mean, if you want to discount it a little bit or work a little longer because you're worried something might happen to your Social Security or your pension or your non-governmental 457B, I think that's okay. But totally ignoring it, that seems not a great idea. The other approach, of course, investing in taxable instead of funding your pension or funding a non-governmental 457B has its downsides too. Not the least of which is asset protection concerns, right? If you're sued above policy limits, whether it's a personal, injury lawsuit from your kid hitting somebody with the car, or whether it's a malpractice lawsuit, if it's, a big judgment above policy limits, it's upheld on appeal and you got to declare bankruptcy, you're probably losing your taxable account. You'll keep your 401ks. In most states, you're going to keep your IRAs. You might keep some home equity, but the taxable account's probably going away. And so that's the reason why you might want to prefer to save for retirement and pensions and a non-governmental 457B rather than a taxable account. The other problem is the money grows slower, right? It's got tax drag on it. Every time it pays out a dividend or every time you realize a capital gain because you got to make some adjustments in the portfolio, you're paying some taxes. And so it grows slower in the taxable account. So I don't think that's a good option either. Now, if I was worried about my non-governmental 457B, I might not fund it more than just a little bit, right? Maybe you want to put $50,000 total in there, but you don't want to put $500,000 total in there. Or maybe you want to put $5,000 a year in there instead of $23,000 a year in there. Use it a little bit if you're a little worried about it disappearing. But I've certainly had WCIers write to me that they were worried they were going to lose their 457B. And there was a couple of years where they're worried the hospital was going to go under and something was going to happen to them. And they told me they wished they'd never invested in the 457B in the first place. Now, this is a doc who got the money, didn't lose anything in the end, but wished he'd just done it in a taxable account to avoid that worry and hassle. And so keep that in mind if you're making that decision, find the balance there. Now, in this particular case, you're talking about 55% of your savings going into the pension and presumably a non-governmental 457B. That feels like a lot to me. I think if I were in that situation, maybe I wouldn't use the 457B and I'd invest in taxable instead. Or maybe I'd limit how much I put in the 457B or just use it for 2 or 3 years or something like that in order to maybe decrease that ratio. Because it does make me a little uncomfortable that 55% of your savings is going into accounts, that are subject to your employer's creditors. It's probably fine. If the employer was the state, for instance, I wouldn't worry about it nearly as much, but it does make me think about it a little bit. So moderation in all things, maybe dial it back a little bit and maybe build yourself a little bit larger taxable account than you would otherwise because of that concern. All right, our next question came in by email. A couple of weeks ago, you talked about setting up the Backdoor Roth 401k. You mentioned there had to be 3 sub-accounts, a pre-tax, a post-tax, and a Roth. Then you outlined the steps of contributing to the post-tax and converting to the Roth. For 1099 people who set up their 401ks through an outside party, this person used my solo 401k, and you just write a check from the business to the Roth 401k sub-account and not have that after-tax sub-account. I met with my accountant and she said you can contribute employee and employer contributions directly to the Roth 401k. She said that it's not a mega backdoor Roth when you do this. So I guess my question is, what's the difference? Why do you need the extra sub-account and the extra step? What's the difference between mega backdoor Roth and just contributing directly to the Roth 401k? Okay, let me go over this and see if I can make it crystal clear. You can make Roth employee contributions. Okay, the employee contribution, sometimes called an employee deferral, for 2025 is $23,500. Okay, for those under 50, it's going to go up in 2026 and later years. Obviously, it goes up with inflation every year. Okay, that thing can be Roth. It can also be tax deferred. Okay, the employer contributions, 20% of net income, can also now be Roth. Okay, employer match, for lack of a better term, is what that is. And that can be Roth too. So if you can get to $70,000 between the employee contribution and the employer contribution. 70,000 is the maximum 415C limit for the 401k for 2025. It'll go up a little bit in 2026. But if you can get to your 70,000 just from those two, then you don't need to do make a backdoor Roth. Okay. So that's possible that's what this person's accountant is telling them. More likely, the accounting is just a little bit confused because not very many of their clients ask questions like the ones white coat investors tend to ask. For most of us, you don't make enough at the side gig. You don't make enough at the 1099 to be able to get to your 70,000 just with employee and employer contributions, especially if this is just a side gig, right? You've got a W-2 job somewhere with its own 401k. Because a lot of times you've already burned the employee contribution in the employee job 401k. You only get one of those employee contributions. It's a $70,000 limit for every 401k you're eligible for unrelated employers. But it's only one $23,500 employee contribution, no matter how many you're eligible for. So if you burn that already at the main gig, you can't use it in your solo 401k. Well, that's going to make it harder for you to get to the $70,000. The other limitation is that employer contribution is 20% of net income, net business income. So you got to make a certain amount of money. If you got to put all 70 in as employer contribution, well, that's 70 times 5 you got to make in that gig, right? That's $350,000. That's a pretty good side gig you got going. I guess if that's the only thing you're doing, maybe a doc can get there. But most docs, when we're talking about a second 401k and a side gig, you're not going to get to 70,000 just from the employer contributions. But if you make, $80,000 or $100,000 at this side gig, you can still max out that 401k as $70,000. You can still hit the 415C limit, but it's going to involve doing some or all of your contributions as mega backdoor Roth contributions. Okay, so this is a two-step process, just like the regular backdoor Roth. It's an after-tax contribution into the after-tax sub-account in the 401k. And yes, it has to have an after-tax sub-account for you to do this. And then a Roth conversion. So the plan has to allow you to make after-tax employee contributions, not Roth, after-tax employee contributions, and it has to allow for in-plan conversions, or maybe you could, roll it out of the plan if the plan allows that and put it into a Roth IRA. But usually it's an in-plan contribution in order to get to that $70,000. So I hope that's helpful for this particular question. It's not a big deal to have a third sub-account. It's not like, these 401k providers charge you extra for that other account. I mean, every employee at WCI has 3 sub-accounts, right? And nobody ever has any money in that sub-account for longer than a day, right? That third sub-account just kind of sits there with $0 or 2 cents or whatever in it until it gets used again next year for anybody doing a mega backdoor Roth. I think it's mostly just Katie and I doing them. But that's, how the process works. Hope that's helpful to you. All right, next question. This one comes from John. Another question about side gigs.
Dr. Dolly, I am a surgical subspecialist in the Southwest. I have a solo private practice and have been practicing for over 20 years. Through my practice, LLC, I maximize all retirement savings. As my practice has matured, I have taken on several side gig positions, serving as a medical director for a hospital and as a consultant for different companies. For this side gig work, do you recommend establishing a separate LLC, which is independent from my medical practice? If so, would you also recommend obtaining an insurance policy for this new company, such as an umbrella policy? I do not plan on employing anyone through this new company anytime soon. Thank you for your recommendations.
Great question. There's a little bit of gray area here of what you need to do, what you want to do, what some people would recommend you do, etc. A few things to think about as you make this decision. Forming LLCs and buying insurance policies are primarily all about asset protection, right? You're trying to prevent some terrible liability situation from causing you to lose money. So for this reason, when you're practicing medicine, you get malpractice insurance, right? For this reason, when you're building a rental property empire, you put those rental properties inside LLCs. It provides both internal and external liability protection. Okay, by external, you're protected from some liability in another part of your life. For example, you get sued for $1 gazillion for malpractice, and it's not reduced on appeal, and you happen to own some LLC with some other partners. Well, they can't just go take the LLC because it's a totally separate entity. Now, if you are distributed money from the LLC, that could be used to meet your judgment, but they can't just go form the LLC to sell whatever the LLC owns because it'll hurt, the other 15 partners in your LLC. And so it provides some external liability protection there. It also provides internal liability protection. Let's say whatever that LLC is doing, let's say it's a rental property and somebody slips and falls on the rental property and sues the LLC for $1 gazillion. And well, the nice thing about it is, at worst, you're only going to lose what's owned in the LLC. So that's internal liability protection. Now, the first line of defense to any of those liability situations, of course, is insurance, right? On the personal side, you buy homeowners or renters insurance, you buy an auto policy. Hopefully, if you're a good little WCI, you've stacked an umbrella. On top of that, that's for additional personal liability. Most physicians probably ought to have a 7-figure umbrella policy. The good news is that usually only costs a few $100s a year. It's much cheaper than your malpractice policy. Whether that LLC will cover any business liability is a totally separate question. It's certainly not going to cover any of your malpractice liability. I can tell you that. Maybe some little tiny amount of business liability it will cover, but in general, do not expect your personal umbrella policy to do much for your business liability. So now we get to John's question, which is, do I need some additional asset protection? Do I need some additional liability coverage here? Well, I guess it comes down to what liability do you have, right? You're serving as a medical director. Okay, well, I guess there could be some liability there. You're doing it for a hospital. Are they providing you some sort of, a malpractice or liability insurance coverage for that? If not, I'd look into, getting it added to my malpractice policy or looking at a personal or rather a business liability policy for that work. I think there's probably enough liability doing that. Now, the consulting, I don't know exactly what you're doing, how much liability there is there. You might look into a business liability policy for that. Maybe there's just not that much liability there. Lots of things I've done in my life, there's just not much liability. It's probably not worth buying a policy for. But it sounds like there might be. So maybe it's worth looking into a business liability policy. The good news, again, is generally a lot cheaper than malpractice insurance. Now, should you put that business in an LLC? Well, everybody wants to put every business in an LLC all the time, it seems like, which isn't the end of the world, right? In Utah, it cost me $70 to form an LLC and then $15 a year and 1 page of paperwork. It's not a big deal. I formed LLCs. It's not hard to do. Do you want to go form an LLC? Form an LLC. But keep in mind that it doesn't do a lot of magic stuff in a lot of situations. A lot of people want to form an LLC or a corporation because they think they're going to save a bunch of taxes. Well, in the end, it doesn't end up saving them any taxes, and maybe even increases your taxes depending on exactly how it's formed. So keep in mind, you need to know specifically what taxes are you going to save on that you couldn't do as a sole proprietor. The other reason, of course, is liability. And, theoretically, if there was some liability that only applied to this company, to this consulting you're doing for the company, all they could get if they successfully sued you is what the company owns, maybe the business bank account, that sort of thing. But when you're the only member of the LLC, in a lot of states in particular, it really doesn't provide a lot of extra asset protection there, because the court goes, what are you talking about? This isn't hurting anybody else to sell what's in the LLC other than you, and you're the one who has the liability. So we're going to force you to pull that out of the LLC or whatever. And so it really doesn't provide the same protection that a multi-member LLC might. Now, is it worth separating this business from your main business? I can't really tell. I don't know that I have enough information there, what the downsides might be to just lumping it all in together to your main practice. You might consider doing that. It might save you some hassle. or it might make things more complicated. Maybe it's better to have it simpler, have its own bank account, its own credit card, its own LLC. It's not that expensive or that complicated to do all that. So maybe if you want to treat this as a separate business, you can do that. Chances are, if you own the practice and you own this other LLC, you're not going to qualify for another 401k though. So don't think just forming an LLC gives you another 401k. That's not the way it works, because those businesses are probably related. You probably have 80% ownership of both of them. So they're related businesses, only one 401k for those. So sure, go form an LLC. You can look into an insurance policy as well. But consider how much liability you actually have. It might not actually be that much depending on what you're consulting on. And the main liability from being the medical director is probably provided by whatever you're being the medical director for. So I don't know that you need a separate business liability policy for that. All right, let's take another question. This one from Chris.
Hi, Jim. This is Chris from California. My partners and I have questions about 1099s. With our finance manager in our office, 1099 has become a bit of a four-letter word. We have a hospital group that has about 60 physicians and a few administrative staff, and we cover 3 separate hospitals. We're structured as a C Corp, and we do control the employees in that we make their schedule, their hours, quality metrics, expectations, etc. So the way we interpret the law is that these doctors should be W-2 employees, and they are with our group. However, there's a lot of groups that do 1099s or give people the option to be a W-2 or a 1099, and that does make it a little bit difficult to recruit people, even though we've explained to them that you can't deduct all the things they think they can deduct. Are these groups that are doing these options of W-2 or 1099 or just doing 1099s breaking the law and they'll get caught at some point? Or is this something that is so unlikely to get audited they don't care? Or is there some exemption for physicians we can't find? Any input on this would be greatly appreciated. Thanks for all you do.
No, I think you actually understand the issues here. There are a lot of docs who do not understand the issue. They think this is just a choice they can make. It is not a choice you can make. The IRS gives guidelines on what an independent contractor is and what an employee is. Right? And there's a whole long list of what these guidelines are, right? There's a little bit of gray in this area, but not nearly as much as most doctors think, right? If the company is telling you how to do your work and where to do it and providing you benefits and, and there's a bunch of employees and, all this stuff that goes into this long list of factors that the IRS tells you to consider when deciding if somebody is an employee or an independent contractor, you got to be the employee. That's just the way it is. And the accountants are usually pretty good at pointing that out. Now, sometimes people kind of turn a blind eye to it, and let's be honest, people get away with it a lot. But the truth is, most of the risk here is actually not on the doc. It's not on the employee / 1099 person. It's on their employer. Because what can happen to them is that you decide you're going to be a 1099 or they decide you're going to be a 1099. They don't withhold any taxes for you as they pay you. And then a few years later, you come back to the IRS and say, I was basically an employee. They should have been withholding taxes. Go to them and get the taxes. And the IRS goes to the employer and gets the taxes. That's the risk, right? It's these payroll taxes are not withholding. And so the actual risk to the employee is pretty minimal, right? They don't come after them for the taxes. So that's kind of the issue there. So if you are the employer, if you're this group that's the employer, yeah, you've got risk. If you hire all these docs and tell them they can be 1099 and really they're employees and the IRS comes back in a few years and say, really, they're employees, you owe us the payroll taxes, then you got to pay the payroll taxes. And so that's your risk. So you really do have to classify people properly. There's a little bit of leeway there, but not as much as most people think. You can go there and, you can look these up. If you go to IRS, independent contractor or employee, I'm sure that'll find us, a good long list of how to tell one apart from another. Here we go. IRS.gov. It says independent contractor or employee. And it gives all kinds of things you ought to be thinking about here, right? So it says the common law rules. Well, there's behavioral. Does the company control or have the right to control what the worker does and how the worker does his or her job? Well, if so, they're an employee. Financial are the business aspects of the worker's job controlled by the payer. These include things like how the worker is paid, whether expenses are reimbursed, who provides tools and supplies, etc. And third one's a type of relationship, whether written contracts or employee-type benefits, that is pension plan, insurance, vacation pay, etc. Will the relationship continue, and is the work performed a key aspect of the business? Right? The idea is an independent contractor is somebody that comes in for a limited time and does a limited amount of work, and and takes care of all their own benefits and all their own tools and expenses, and decides when and how they're going to work. Well, that's not the case if you're a doc working in an emergency department, right? They're scheduling you on a shift. They're providing all of the assistance to you, all the nursing staff, et cetera. All the tools you work with are provided by the employer, and now you want to call yourself a 1099? Really? That's not probably going to fly. Do people get away with it all the time? Absolutely. Is it an awesome thing to be a 1099? Well, it depends. If you get paid enough more that you can cover your taxes, your additional payroll taxes, and you can cover the loss of all those benefits that now you're paying for, it's fine to be a 1099. But the risk is really with the employer. So that sounds like it's you and your partnership is who the risk is with. And, so if people want to be 1099s, you can't let them just be 1099 just because they want to be. You might get away with it, and maybe they won't come back and tell the IRS about what you're doing, but maybe they will. So I don't think it's a risk I would do. We don't have 1099 employees or whatever in our group. They're employees. They get a W-2, and that's the way it works. You're either a partner or you're an employee, and that's it. So if you don't want to be one of those things, maybe your group is not for those docs. But no, you guys are probably doing it right. If you're looking at those IRS factors and deciding these are not independent contractors, they're employees, you're probably doing it right, and they are doing it wrong. Whether they get caught doing it wrong or not, totally different question. I don't think this is a super frequently audited item, but I can tell you exactly how often it gets audited. As I mentioned at the beginning of the podcast, SoFi can help medical residents like you save thousands of dollars with exclusive rates and flexible terms for refinancing your student loans. Visit SoFi.com/whitecoatinvestor to see all the promotions and offers they've got waiting for you. One more time, that's SoFi.com/whitecoatinvestor. SoFi student loans are originated by SoFi Bank, NA member FDIC. Additional terms and conditions apply. NMLS 696891. All right, don't forget about our real estate webinar. Go to whitecoatinvestor.com/REI. That's November 20th, 6 p.m. Mountain. Thanks for those of you leaving 5-star reviews and those of you telling your friends about this podcast. A recent one came in that said, "Excellent. I'm a clinical pharmacist and I've listened to almost all of the podcasts since I subscribed. I've recommended the book to my relative who is a physician resident. These podcasts are informative, confirm what I've been doing right, what I need to change, and help me expand my knowledge. I particularly enjoyed the episode on cryptocurrencies. What got me started was the book recommended to me by a colleague and the down-to-earth, easy to understand, and honest podcasts." Thank you from Ben, 5 stars. Thanks for that podcast or that review, Ben. That does help us get the word out to other people that need this information just as much as you and I did before we got it. Keep your head up, shoulders back. You've got this. We're here to help. See you next time on the White Coat Investor Podcast.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.